Over the last 6 months, I've had calls from multiple clients saying that they are done with buy-to-let investing. These are people that have been investing in property for decades, but have decided that it's just not worth it anymore, and they want to sell. Over the last 30 years, buy-to-let investing has been a way for middle-class people to invest their money and create an income for themselves in retirement. For many, it seemed to be the only way to invest, as they don't trust pensions or the stock market. But over the last few years, the government has made a series of changes to legislation that, along with higher interest rates, has brought the buy-to-let market to its knees. So I'm going to show you the cash flows of one of my clients' rental properties from 2017, and then I'm going to show you what it looks like now. If you're a buy-to-let investor, I imagine you're all too familiar with what you're about to see. But if you're not, well, this is going to shock you, because it certainly shocked me. And the ramifications of this for investors, but more importantly, the wider rental and housing market, could be huge. Hello and welcome back to the channel. If you're new here, hi, my name is James. I am a financial planner, and this is a place where you can learn about saving money, investing, and over time, building yourself into a position of financial independence. I stress this because I know buy-to-let investing is a highly divisive topic. You have buy-to-let investors on one side, and then you have renters on the other. And arguably, if things are bad for investors, then they are even worse for those that are renting. But given that this channel is about investing, I want to show you what is going on from the perspective of investors. This is the list of changes that the government has made over the last 15 years that has made buy-to-let investing much less attractive. Our journey starts in 2017. So by that point, the government had already removed indexation relief for capital gains, increased stamp duty by 3%, and increased the rates of CGT on property to 18% and 28%. And I'm going to talk through the rest of these as we go through this. The property we're looking at is a 1-bedroom flat in Oxford, which my clients own in their personal name rather than through a company. In 2017, the value of the property was £190,000, and the annual rent was £11,100 a year, or £925 per month, which gives a rental yield of 5.84%. The average UK rental yield is about 4.75%. So this yield is certainly higher than you might find in London or other southern areas, but not as high as you might find in the north. For costs, we have letting agent fees, gas safety certificates, service charge, ground rent and insurance, and maintenance, leaving a net income after direct costs of £8,650, which is a 4.55% yield, which is not bad, seeing as this property may also see capital appreciation of 3 to 4% per year on top of this. This is the return that you would get if you had no mortgage on the property. But this property had a £125,000 interest-only mortgage at a rate of 3.5%. So after all costs, they were left with £4,275. And given that they have £65,000 of their own capital tied up in this property, that's a return on capital of 6.58% per year. Plus, they're going to get potential capital growth on top of this too, which shows you why investors like to use leverage to boost their returns. It's these headline figures that make property investing seem so attractive. But what they don't show is the risks, because there will be years where appliances need to be replaced or boilers need to be fixed, where there's leaks or damage that needs more substantial repairs. Then you'll need to redecorate every 5 years, replace the carpet every 8. You'll need a full electrical inspection every 5 years. Then, of course, there's the risk that if you are without a tenant for a month, or you get a bad tenant that refuses to pay rent or damages the place, then you could see yourself making a loss for a long period of time. All investments have risk, which is why you should never assess an investment based on its headline return. You always need to put that into the context of the risks that are being taken. And generally, the higher the yield or the return on an investment, the higher the risk. And when you add in leverage to the mix, all of those risks just get compounded, as you're about to see. So let's look at how things have changed between 2017 And now, the value of the property has increased to £250,000, a 31% increase. Rent has gone up to £14,160, or a 27.5% increase. To help you put these figures into perspective, inflation is up by about 27% over this period. So both the value of the property and its rent have risen roughly in line with inflation. For costs, letting agency fees are up 27%, the same as rent. Gas safety certificate up 55%. Got service charge and ground rent up 103%. And then we've got maintenance up 42%, which brings total direct costs to £3,986, or an overall increase of 63%, tracking well ahead of inflation. Net income after direct costs has increased to £10,174, but because the value of the home has increased to 250k, the yield is down slightly at 4.07%. The mortgage is the same value, but because they refixed their mortgage, the rate has actually gone down to 2.2%. So with total mortgage interest of £2,750, the net income is much higher than in 2017 at £7,424, which sounds great, but it's not. In 2017, the owners were higher rate taxpayers. So to calculate their 2017 tax, we would simply subtract 40% from their profit, leaving them with an after-tax income of £2,565, or a 3.95% net of tax return on capital. If we go through the same process but with the 2023 figures, they would end up with £5,000 after tax, or a 3.5% net of tax return on capital. However, since 2017, the government has changed the way that mortgage interest works in this calculation. In 2023, if you are a buy-to-let investor that owns the property in your personal name, you can no longer deduct mortgage interest as a cost of doing business, which means that their taxable income is now much, much larger. However, the government has introduced a 20% tax credit for mortgage interest, which means that you can get 20% of your mortgage interest off your tax bill. The idea behind this is that if you are a basic rate taxpayer and all of this taxable income still falls within the basic rate band, then you would be no worse off. However, because your taxable income is now much larger and income tax bands have been frozen for the last 4 years, it's now much more likely that investors will be pushed into these higher tax bands. Given that the owners are already higher rate taxpayers, the result is that they have to pay 20% of their mortgage interest in additional tax. So in a way, this is a tax on mortgage interest. So when interest rates are low, the effect is muted. But when interest rates are high, it makes the situation much, much worse. This has been a hugely divisive policy for a number of reasons. Firstly, well, obviously nobody likes to pay more in tax, but this just doesn't seem fair because other businesses, like a car rental business that uses finance to buy the cars, or a manufacturing business that borrows money to purchase machinery, can offset the interest that they pay against their income. It's just a cost of doing business, and then they only have to pay tax on their profit. Even if you run a holiday rental business, so you run an Airbnb, you can still do this. But for some reason, the government has decided that buy-to-let investors that are providing rental accommodation for long-term lets can't. What's even stranger is that this only applies to those that own buy-to-let property in their personal name. If you own the property inside a limited company, it doesn't apply. Putting property inside a limited company has only become popular recently and is generally only cost effective if you have 3 or more properties. So this policy is specifically trying to make it harder for smaller investors and those that have been investing for a long time and just built up multiple properties in their own name. But as we can see here, even with the higher taxation, this is still a fairly profitable investment. Well, right now it is, but the fixed rate on their mortgage is due to expire at the start of 2024. So they're currently looking to get a new fixed rate offer. At the time of recording, the average 2-year fixed for a buy-to-let mortgage is about 6.5%, or 6% for a 5-year fixed. So if their mortgage rate triples to 6.5%, this is what's going to happen to their cash flows. Their income before tax is going to drop from £7,400 to £2,000. Under the old rules, they would then be taxed on this profit at 40%, leaving them with £1,229 after tax. But with the new rules, they are going to end up having to pay more in tax than the income that they have made. Imagine that, going out to work for a day, and then the tax man is sending you a tax bill for more money than you earned that day. What's more is that this property has a relatively low loan to value of 50%, whilst many buy-to-lets have mortgages of up to 75%. If that was the case with this property, they would be losing £300 per month, or that's a minus 5.8% return on capital per year. Clearly, this is not a good situation to be in. So what can they do about it? Well, if you've never been a landlord, you're probably thinking that they can just put the rents up, right? But that is not how the rental market works, or any market for that matter. The current tenant is due to leave in March 2024. So the rent is fixed until then. And when they do leave, the owner will go to their letting agent, who will put the property on the market for whatever the going rate is for properties in the area. They could try and put it on for slightly higher than the market rate, but if it's too high, they're not going to get many viewings and they could find themselves without a tenant, which is a big risk given that this property could be losing £1,000 per month. Yes, if the aggregate costs across all landlords are increasing, we would expect rents to increase too. But given that lots of landlords don't have a mortgage, own their properties inside limited companies, and are remortgaging at different times, market rates are unlikely to rise in line with your costs. So for the most part, landlords just have to accept whatever rate the market is offering at the time, with those market prices set by supply and demand, which is a point we'll come back to later. So what else could they do? What about owning this inside a limited company? With that, you would get a better tax treatment, but the interest rate on mortgages held by limited companies are generally 1% higher, which would leave you with a measly 0.64% pre-tax return on capital, with that profit likely being eaten up by the higher administration costs of running a limited company. So no, that's not going to work, meaning that they may have no choice but to sell. And if they can get 250k for it, well, that's not all bad, given that they've received pretty good returns up to this point. But who's going to want to buy this property at that price? Certainly not another investor, because if they bought it with a mortgage, then they would be in exactly the same situation. And if they bought it with cash, well, who's going to want to invest in a risky buy-to-let that yields 4% per year when you can get 5% on a risk-free, hassle-free government bond? Think about that. Given that you can now get 5% interest on cash in the bank, how large a yield would you require to buy this property? Think about all of the risks involved and all the hassle that you're going to have to put up with. What would you require? 9%? 10% at least. So for this buy-to-let to become an attractive investment, either rent has to double or the value of the property has to fall by 50%. And I don't think either of those things are going to happen. This is the problem that is happening with buy-to-let properties all across the country. So what does this mean for the rental market as a whole? Of the UK's 23.7 million households, 4.4 million of them are private rentals. So roughly 20% of UK housing stock is buy-to-lets. With interest rates where they are, the vast majority of these are no longer attractive when you compare them with other investments that you could make, especially when you consider the fact that the government has a bunch of other policies lined up that are going to make buy-to-lets even worse. So it's likely we're going to see a lot of landlords exit the market, which some people think is a good thing because they are then freeing up housing supply for people that want to buy it and live in it themselves. Now, I'm not an economist, but I don't think it's that simple. Rents are set by supply and demand. If the supply of rental properties goes up, or demand goes down, then all else being equal, rents should fall. If the supply goes down or demand goes up, then rents should rise. Let's say that my clients sell their one-bedroom flat to the person that is currently renting from them. So we've taken one renter out of the market and we've also taken one rental property out of the market. Supply and demand are balanced, so rents remain the same. In theory. But my clients also have another property, which is a 6-bedroom student let, which is also going to become unviable when their mortgage rate goes up next year. So let's say that they then sell that property to a family of 4 that were previously renting. We've removed 4 people from the rental market, but we've lost the supply for 6. And actually, hang on. Instead of selling that one-bed flat to a renter, they could just turn it into an Airbnb, because not only might they get enough income to sustain their property, but the government's tax on mortgage interest will no longer apply. So if all across the country, landlords are being forced out of long-term buy-to-lets in this way, that is only going to reduce supply and increase demand, pushing rental prices higher and higher. So do you see how these government policies are actually making the situation worse for everyone? After hearing all this, you probably think that I sympathize with landlords, but for the most part, I don't. Because landlords are investors, and like all investors, they should be comfortable with the risks of the investments they make. They should expect there to be times when the market will turn against them, when interest rates will rise or prices will fall, and they will lose money, especially if you're using high amounts of leverage. And although it sucks when this happens, it should not be unexpected. And if it is, then you've clearly not done your research. But what I do have sympathy for is when people are working hard to save and invest money for their retirements, and the government keeps coming in and moving the goalposts. As I said at the beginning of this video, many people see investing in property as the only way to build wealth and invest for their retirements. But the government has decided to tax retail investors out of the market, and it's only going to get worse. I appreciate that this video is very different from my other ones, because normally I bring you problems and then I give you solutions. But unfortunately, I've got no solutions to give you because I don't actually know all that much about property. I'm not a big property investor, and I certainly don't know anything about setting government policy. But the only takeaway I can give you is that it is now so important that alongside property, you make use of the other generous tax-efficient tools that are available for building wealth. And if you want to learn what they are and how you can use them, well, that is what this channel is all about.